You might need to see your doctor after watching this if you are an income investor. An $860 million gamble just hit the American energy sector. This week, USA Compression Partners, ticker USAC, made its biggest bet yet, and for thousands of income investors, their beloved 8.32% dividend could be in danger. USAC is buying its biggest privately held rival, J.W. Power Company, in a move management calls transformative. But the deal's structure has analysts issuing warnings. If they've miscalculated one thing, the high yield you rely on is at risk. This is the breakdown of the $860 million deal and the single mistake that could cost USAC its growth. To understand the risk, you need to understand the reward. The energy market is hungry for USAC's services. Natural gas compression. By acquiring J.W. Power, USAC adds over 800,000 active horsepower across every major U.S. basin, from the Permian to the Bakken. This expands their total fleet to an astounding 4.4 million horsepower. It's a strategic win. Analysts say the combination makes USAC a true market leader, and management projects the acquisition price is a reasonable 5.8 times J.W. Power's 2026 adjusted earnings. But the price tag is only half the story. The financing is where the risk is buried. Here is the structure of that $860 million, $430 million in cash, and $430 million in new USAC common units. The cash portion must be raised, most likely through new debt. That is an immediate strain on the balance sheet, increasing leverage right out of the gate. But the equity portion is the real concern for existing shareholders. USAC is issuing roughly 18.3 million brand new shares to the seller. Why is this a danger? It's called dilution. When a company issues millions of new shares, every existing unit you own suddenly represents a smaller piece of the total profit pie. And when your primary reason for owning USAC is that hefty 8.32% quarterly dividend, dilution matters. The company argues this deal is accretive, meaning the earnings from J.W. Power will grow faster than the dilution. But that requires flawless execution and perfect market conditions for the next 18 months. The good news: analysts at firms like Texas Capital are cautiously positive. They see the deal accelerating USAC's goal of achieving a manageable sub-4.0x leverage ratio. The bad news: if there are any integration hurdles, if J.W. Power's earnings fall short, that debt load and new share count could force management to conserve cash. And the first thing a master limited partnership cuts to save cash is usually that generous dividend. This deal is a massive high-risk, high-reward move expected to close in Q1 2026. If management is right, USAC solidifies its market dominance. If they are wrong, the unit price will suffer, and the dividend you rely on will be the safety valve they use. Your move. Do you trust USAC management to pull off this $860 million gamble? Let me know if you are buying, holding, or selling in the comments below. And subscribe for updates and analysis on the biggest trends.